Have you heard of the term token unlocks before? This term doesn't frighten you, it should. Here's why you should be worried. Early investors receive tokens at a heavily discounted price than what the retail market gets them for. This isn't always the case, but it's true in 99% of tokens. They can get it at less than 1/10 or even less of the price than the retail market gets it at. This is of course to reward the early investors for the risk that they're taking investing early. If the company does not launch, the investor would lose all of their investment. The problem with the crypto world is that it runs on hype more than adoption. It's possible to hype a project without it ever really having a working use case in the real or crypto world. And in the world of memes and rocket ship emojis, hype is the way most projects get noticed, whether we like to admit it or not. And I mean, what better way to convey meaning than a single idea, narrative, or photo that propels a project into millions or even billions of dollars in value? The future of the fill in the blank this or the best metaverse project that, or even the think Amazon or Facebook but crypto type projects come up every day. To know early on what a project will do is next to impossible. The truth is most value producing projects in crypto and the world outside crypto takes years to truly offer value and sustain it. Overnight success of a project is rare, and you usually don't hear about it until it's already successful. So what is a token unlock? When early investors invest in a project, they are promised the token at a later date, or a sequence of later dates spaced out over months or years. Early investors receive such a good deal on the token and usually invest hundreds of thousands or millions of dollars in a project, they in turn become whales of that project. The price of the token of a small project could plummet 30% or more on a single sale of a whale and make the community of a project less hope. Why is this? Well, because crypto investors are much more reactive to price than they are the actual utility of the project. Even if the project was the next hyped Amazon, Google, or Netflix of crypto, a 30% red candle in a day would freak out those invested in the project. Understandably so, especially since life savings and crypto horror stories are too common. So token unlocks are a way of slowing the release of tokens to early investors in hopes that their inevitable token sales won't drop the price dramatically when they do dump them. And they will, and it's only a matter of time. Token unlocks can have different meanings in a bear and bull market. Let's talk about the bull market unlocks. The bull market unlock meme came from the idea that unlocks would allow people a new supply of tokens to purchase at a great price when the early investors sold them in bulk. A whole new reason to buy the dip in price. Also, in a bull market, whales may not choose to dump their tokens as they may go up in price significantly in a few weeks or months. So instead, they hold on to them in hopes that their token rises in price before they actually choose to sell them. Another justification given for bullish unlocks was the reasoning that the early investor may choose to sell to bigger players by doing OTC deals. This means that they sell their unlocked tokens over the counter to big players at a discount instead of pressing the big red button and selling on the open market. This allows the early investor the ability to sell without affecting market prices. This of course puts the token concentration in the hands of another group or fund, but the idea in the heads of many was that the new whales would secure the project long term by holding on to their newly acquired tokens. When token unlocks happen and the early investors choose to not sell them on the market, it gives the feeling that the early investors are committed long term to the well-being of the project. In 2021, the bullish unlock narrative was supported into existence by none other than Zhu Su. At a current follower count of 566,000, this puts him in the top tier of crypto influencers. And being a public-facing co-founder of Three Arrows Capital, he garnered a lot of trust and influence by both retail traders and long-term crypto natives. Since the June 2022 blow-up of the Three Arrows Capital, Su Zhu has been revealed as the emperor with no clothes, showing that he didn't have the understanding on the crypto market that he led the crypto world to believe. His thesis such as bullish unlocks and supercycle have been proven false in 2022. When things are going up in price, it's easy to seem like a genius, but when it starts reversing, we see the same people and narratives like bullish unlocks turn against us. Now let's switch gears and talk about bearish unlocks. When the market starts to trend downward, the idea of holding long term for many evaporates overnight. Panic selling their once favorite project for stablecoins becomes the norm. Bear markets can last years. And most crypto projects, even including the biggest piece of the crypto pie, Bitcoin, can drop 80% or more in value from the previous high to the lows. As most bear markets last multiple years, those who manage large accounts like funds and other actively managed whale accounts tend to sell during this time, or just because when euphoria and greed are at their highs. This puts even more pressure on the price. But who could blame them? If millions would turn into thousands and you depend on that income, we hope you do the same. The idea of diamond hands makes little sense when dealing with multiple year drawdowns. Yes, Bitcoin and the crypto market have gone up eventually, but selling low and buying lower can be much more profitable for those who have millions of dollars and investors to listen to. And those funds like Three Arrows Capital, who believe their own up-only hype, ended up insolvent. And the hundreds of thousands who followed them are either selling at a major loss or not looking at their balances in their crypto wallets for another few years. Now on to market cap and the fully diluted market cap explained. You've heard of market cap before, which is the amount of tokens in circulation multiplied by the current price. Now, for the sake of a food-based example, let's say my store currently has 100 pies. I sell them at the price of $2. That means that the stock of my pies is worth $200. 200 would be the initial market cap of my pie store. Now let's say that these pies are never eaten, as they are too incredible to eat due to their everlasting fragrance and design. Now, people catch wind of how wonderful these pies are and want to buy them for themselves. As these are limited edition pies, I slowly raise the price as I know people want them. Raising the price of my pie raises the market cap of the store. Since all of my pies are limited, the previous customers decide to sell them to new people. Since they are in such high demand, they sell them for double, triple, even 50 times the amount they paid for them. With each pie now worth $100, the market cap of my pie store is $10,000. And those who bought for $2 now can sell for $100, meaning profits for them. Now let's talk about FDV, or fully diluted valuation. At the beginning of my bakery dream, I had to entice investors. I told them for their investment, I would bake 10 pies for them each month at a price of 20 cents. I told them that I would sell the pies at a price of $2 initially, and that the success of my pies would continue to raise the price in the bakery and on the secondary market. Since they believed in my sales pitch and saw that their initial investment would at least make them 10x, they agreed. I would continue making them until we reached a total of 1,000 pies in circulation. This means that the total supply of my pies is 1,000, and the initial circulating supply is 100 pies. It will continue to increase until I reach a total supply of 1,000. If each of my pies is worth $2, the initial fully diluted market cap, or fully diluted valuation, is 1,000 pies times $2, which is $2,000. This is much higher than the initial market cap of pies, 100 times $2, which is $200. This means that by the time all of my pies are made, there would be 900 more pies on the market than when I started. My investors and I are hoping that the demand for my pies remains high until the new pies are sold out into the open market. Now, if we were a bakery with ill intentions, to make the new buyers believe the pie will still be going up after they buy them, my early investors and I could use a variety of marketing tactics. This has happened multiple times by Twitter accounts with huge followers that dump on their followers after hyping the project even on the same day. They later get revealed by crypto sleuths like Zach XBT, but often move on to new projects with different pseudonyms. Now here's a quick FDV pro tip. You can quickly see if a company is highly overvalued, meaning the FDV is higher than companies that offer more value. For example, if a metaverse gaming token has a higher market cap than a long-established video game producer like Capcom, you can make a decision that the 3-month-old token will not be able to sustain the price forever. Now onto the FDV is a meme. Now the FDV is a meme that came across the idea that even if a new crypto company is valued in the billions compared to the real-world competition, it can still go up indefinitely. This happens in a frothy bull market that communicates mainly in rocket ship emojis. It also led to the belief that the fully diluted market cap is much higher than the circulating market cap, and the company is looking overvalued. The price will not be affected when the new tokens are unlocked and releases on the market. This is another case of bull market blindness, and this is truer in a bull market and not in a bear market. When a bull market, when demand for the tokens is high, new buyers have no problem stepping in and buying them up. So the price of the tokens remains the same when the newly released tokens come onto the market. An increase in supply where there's an increase in demand can keep prices quite stable, or raise them as people are okay absorbing the token at those prices. But in a bear market, when demand for the tokens is low, there are no new buyers for these new pies, as those who already have pies are looking for buyers. If early investors want to sell a high amount of those tokens, they would have to sell them at a much lower price than the market wants to buy them for. This means that when they sell them, the price of the tokens will drop significantly. An increase in supply when there's a decrease in demand will inevitably lower prices. That's just economics 101. Now, how to avoid getting pied in the face in the bear market. Bear markets are where those that made their money in the last bull run started accumulating. But beware that many tokens that seemed like good investments in the bear market never reached their all-time high in a previous bull market, and many even went to zero. So how do you know which tokens will rise with the next bull market? Well, there are many factors to consider. We'll focus on a couple right now. The first is to check out their fully diluted market cap versus a circulating market cap. Tokens that have a market cap as close to their fully diluted market cap as possible is a good start. This means that the less tokens will be released over the coming years, thereby not diluting the market and lowering the price of the tokens further than they already are. On CoinMarketCap, you can organize based on market cap and fully diluted market cap with a few clicks. The third way is to study the initial coin allocations and token economics. If you find a project you're interested in, you can go to their Twitter and website and check their white paper. The white paper is usually a slide deck with information about the company's roadmap and investment allocations and token economics. The roadmap tells you the direction that the company plans to take and the milestones they have set to get there. This allows you to see how the company is performing relative to their initial plan. But companies can always adapt and targets can change. See how they are with their public announcements on Twitter and Discord as well. Investment allocation allows you to see what the percentage of tokens given to early investors and how much went to the public sale. As a general rule, the more available to the general public means more organic growth and price action that will be more sustainable long term. Token economics is the way that the token has been programmed to rise or fall in price. Does it burn tokens to decrease supply and increase demand? Or does it print new tokens all the time, which could lead to more inflation? The fourth is to study major whale wallets. You can also track major token holders, aka whale wallets, on the blockchain scanner that each blockchain has, like Etherscan, and using a product like Nansen. Whales are a great way to track the flow of millions of dollars in the ecosystem. Whales have a lot of skin in the game, so their moves usually signal where the future money is going. This topic deserves its own video and we'll probably get one in the future. Let us know in the comments if you'd like us to make a video on how to track millions of dollars in crypto. Now, the fifth is studying coins with upcoming unlocks. A notable moment in crypto history happened in late 2021 when a predominant and legendary crypto Twitter account, Gigantic Rebirth, tweeted that he was hiring someone to research upcoming unlocks of coins on the market. This was particularly interesting as Bitcoin had just hit an all-time high and the rest of the market was screaming Bitcoin to 100K. He shorted these tokens with upcoming unlocks and has mentioned that it has proven to be profitable over the 6 months that followed Bitcoin's all-time high. Because in a bear market, teams dump their unlocked coins into a market with no demand, thereby plummeting the price. Shorting is essentially betting that the coin will fall in price. Now, shorting isn't for everyone, and we only recommend it to traders who understand what they're doing and use proper risk management. But if you want to try with a small amount of capital, feel free to try it out in crypto exchanges that support it. An easier way is just to avoid these coins with major upcoming unlocks. This requires no trading prowess or watching the charts 24/7. Many newsletters and Twitter accounts have come out that research these unlocks so you don't have to. Here are a few notable unlock researchers. The first is Unlock's Calendar. This is the most comprehensive product we have seen so far for unlocks. They have lists for upcoming unlocks, unlocks for the now insolvent Three Arrows Holdings, and even lists of coins with no upcoming unlocks. They stay up to date and are adding relevant lists according to market demand and tweets of their followers. With this type of comprehensive research, a subscription to their Substack will cost you about $50 a month. This subscription will also include an exclusive invite to their Telegram channel where you can receive instant updates. The second is CoinOwl. CoinOwl benefits from its easy-to-read interface, including token unlocks and newly releasing tokens. They even have a list of upcoming and ongoing NFT mints. Their service is currently free, and it's definitely a great place to start if you're wanting to understand token unlocks. And the third recommendation we have is VestLab. This free service provides not only unlock schedules, but even graphics of initial coin allocations. This is helpful for seeing how much the team and early investors were given in the seed rounds. They even include metrics such as fully diluted valuation, so you can track inflation and current valuation. VestLab also gives access to their Telegram group to get up-to-date information. Their website is colorful and the graphics make it easy to visualize the information. Now on to my wrap up. In a bull market, we all develop behaviors that cannot work in a bear market and vice versa. It is the beauty of the duality of the marketplace. Being able to make adjustments quicker than your competition is the recipe for success for those in the market long term. We recommend just watching the dates of a few unlocks to see the reaction of the market to the unlock. When the highly successful bet heavily on these unlocks, it was peak euphoria in the bull market. Now that things have cooled down and the majority of people now realize it's a bear market, betting to the downside isn't as high of a reward as once before. We have provided a good start with the information in the video on how you can deepen your research capabilities. Feel free to go back and watch some of the parts for more clarification. If any of you guys have questions, feel free to reach out to us on Twitter. And I look forward to seeing you guys in the next video.